As usual, we'll begin with the economic data from last week. Monday morning, 8:30, right out of the gate. Bang, look at that. Durable goods orders for July up 9.9%. That's a big number. When you look at June, negative 6.9. That was downgraded to 6.9. And the ex-transportation to up 0.1. The expectation here was 5%, 9.9. But let's take out transportation. Not so impressive. The expectation was for a drop, negative 0.1. We're down negative 0.2. Looking at the ex-defense and non-defense ex-air, both of these are higher than each of their respective counterparts, implying that it wasn't defense or air involved here. This is something in the transport sector, which had a good month in July, but everything else not so great. Dallas Fed Manufacturing Index, negative 9.7. It is negative. Not as negative as it was before, which is an improvement, but still negative. Mexico balance of trade came in better than expected. A small trade deficit. The expectation was for negative 1.35 billion. Look at that number. Much, much better. Consumer confidence for August, 103.3. Up from 101.9, expectation of 100.7. Consumer feeling pretty good about stuff. Richmond Fed Manufacturing Index. Whenever we look at the regionals, looking at their services or manufacturing index, it's been a consistent theme for the last couple of months is negative. Negative 19. Previous was negative 17. That is in contraction and actually getting worse. Shipments, negative 15. Services revenues index negative 11 from positive 5. Heading over to Dallas, Dallas Fed Services Index negative 7.7. It was negative 0.1. So here's the manufacturing in Dallas, negative 9.7. There's your services in Dallas, negative 7.7. Crude oil stocks, not so good here. The expectation was for a drawdown of 3 million barrels. There was a drawdown, but not even 1 million barrels. Gasoline, different story. August 23rd, expectation, negative 1.5 million drawdown, 2.2 million barrel drawdown. Thursday, GDP growth rate, second quarter. This is the second look at it, 3%. The expectation was 2.8. That came in much better. Let's just skip continuing jobless claims now. Corporate profits, 1.7%. Previous quarter, negative 2.7, 1.7%. And the price index, 2.5, down from 3.1 to 2.5, but higher than expectations. So you have an economy that came in for the second quarter better than expectations, and a price index that came in lower than Q1, but still higher than expectations. I don't see this as a 50 basis point Fed in September. I still see, I think they're going to move. They've telegraphed that, but this is a 25 basis point Fed, and I think it's a cautious Fed. So we'll talk about the US dollar in this, and we'll talk about the S&P and what the S&P has priced in terms of the amount of rate cuts and where it happens to be. And keep in mind all of the regional indexes we're seeing for all of the Fed districts are negative. Continuing jobless claims, 1868. The estimate was for 1870. More than what we had previously, but less than estimate. You know, I don't know what to pick on when I look at these things. I say the previous read was 1855 for the previous week. Now it's 1868. That's up 13,000 in continuing claims for a week. Yeah, it's less than the 1870 we expected, but it's still higher. Do I pay attention to the fact that it's not as bad as we thought it would be, or do I pay attention to the fact that the trend is bad? 1855 to 1868. I've always wrestled with that. Initial jobless claims, 231,000. The previous read was 233, which is a worse number because it's red here, worse number than what we initially thought. Expectation was 232, came in 231. So something like that is unambiguous. It came in better than expectations, and it came in better than the week before. To me, that seems like it's going in one, both of those lean in the same direction of good. Whereas this one over here, right? It could be indicating that those people who not many people are losing their jobs based on initial jobless claims, but those who are losing their jobs aren't really getting other jobs very quickly. I think that's the story here. Core PCE prices, this is also continuing on with GDP, quarter over quarter, 2.8% from 3.7, down from 2.9, so that's sort of a good move. PCE prices, quarter over quarter, this is not the core, this is headline, 2.5, down from 3.4, a little lower than the 2.6. Real consumer spending, that is nice, right? 2.9, previous 1.5 expectation, 2.3. So we saw consumer confidence earlier, had a nice bump for August, and this is the second quarter, a bit of backwards looking. This is April, May, June, but 2.9%. Consumer seems healthy. On the end of the last screen, I said the consumer appears to be healthy. Perhaps a better way of saying that is that the consumer continues to deny that they are not healthy. Contrary to what we've seen in some quarterly reports from some retailers about the weakening of the consumer keeps stepping up, saying, not true. Going into Friday, lots of data here. Let's start with Canada, GDP growth. 2.1%. This is second quarter, backwards looking, 2.1. Expectation was for 1.6, so that was sort of a good news print. When we get to the monthlies, down here for June, month over month, 0 came in flat. Expectation was for some growth, 0.1 came in flat. Looking at July's preliminary, came in flat. June, July flat. After this report, if you were on BNN, the Canadian Bloomberg BNN, more conversations were happening about the Bank of Canada this coming Wednesday potentially moving 50 basis points, because you have a stagnant economy at this point. You have 2 months of no growth whatsoever. The belief was the Bank of Canada was going to go 25 basis points on Wednesday. I don't think anybody doubted that. Now it's a question of, well, this gives them, it opens the door and it gives them permission to go 50. I don't know enough about Tiff Macklem to know whether or not he would do 50. Let's look at U.S. core PCE. And with this, I know enough about the Fed to know they are not going to go 50. They're going 25. If you get you'd have to have a jobs number on Friday coming in 60,000, let's say, for them to even consider 50. They're going 25. Core PCE price. This is the year over year. Both these first two year over year, and we'll look at it month over month. Yearly, 2.6%. The previous month's read was 2.6%. No change. Even though it's lower than the expectation, I'm still looking at month over month. It's flat. Also, the core, 2.5% the previous month, 2.5% this month. Yes, lower than expectation, but no change. Let's go to the month over months now for July. 0.2 over June. The previous month was 0.2 over May. No change. The headline, 0.1, actually increased to 0.2. Came in as expected. This does not open the door to 50. You have GDP that came in better than expected. You have a consumer that is more confident than what other sources are sort of suggesting. You have inflation that, well, it's not really a threat anymore, but it's certainly not racing to below 2%. It's month over month, both headline and core, whether you're looking yearly or the month over month, is flat. Looking at personal incomes, up 0.3, higher than the 0.2. They're going home with more money. And personal spending, how's the consumer doing? 0.5, spending more. Increasing their spending by more than their income is spending. The previous month was 0.3. This is basically flipped from the month before, 0.5. We had the personal spending coming in below personal income. Now you have personal spending coming in above personal income. Strong consumer, stronger economy than expected. Inflation, not really a threat, but certainly not coming down. I don't know. Do you see 50 basis points in here? You print 180, 190 on jobs this Friday. This is a 25 basis point Fed. You print 300 on jobs. This might be a 0 basis point Fed. It just might be a 0. I still think it's 25 though, but I don't see 50. I don't see the door open to 50 with only 2 more reports standing in front of now and their meeting, which is the jobs report and CPI. I just don't see it. Chicago PMI, 46.1. This is a diffusion index that is still in contraction. It's under 50, higher than the previous month, getting better, but still in contraction. Michigan consumer sentiment, 67.9. The last month was 66.4. So it has improved, but it's below the expectation, 68. See, I'm unwilling to really put much into the expectation because the expectation is just a bunch of good guesses, right? Whereas 66.4 on a sample basis, statistically, it's measured. On the 67.9, statistically, it's measured. 67.9 is greater than 66.4. This was just good guesses. Well, the median or the average of all the good guesses, but still just good guesses. And is there really a big difference between a statistical measure of 67.9 and a good guess of 68? You know, I don't know too much that I like the looking at the difference between expected and actual when the actual shows a trend over the previous. Here, the consumer, in line with what we saw with consumer confidence earlier in the week, came in higher. Consumers unfazed by anything. 5-year inflation expectation, 3%, unchanged, came in as expected. Inflation expectations, final 2.8, came in lower than the expectation of 2.9, lower than the month before. Consumer thinks prices are coming down. Well, I shouldn't say that. Let me back that up. I sound like a politician now. Prices coming down. Consumers think that prices are going to go up less quickly than they did the month before. They're a little bit more confident about that. Not many of them are losing their jobs, but those that lose their jobs are having a harder time getting another job, even though the economy is clocking in some good growth. Yeah, 25. Well, we have one really big piece of news when it comes to the capital market curve. Let's go to it right away. Here it is right here. Look at the slope. We have a flat curve. The inversion is over. 788 days on the inversion, and it is over. That was a long inversion, but it's done. Do you believe that a recession is now imminent? The curve uninverts before the recession, they say. The curve is now uninverted. Are we on heightened recession watch? Money market rates, let's go all the way out to the 1 year here. Money market rates really coming out. Look at the 1 month, taking out 10 basis points here. The current federal funds rate is 5.33. We pretty much are on track. 100% probability you're going to get a 25 basis point cut in November. There is some probability on a 50 basis point, but I think that is ill-advised. I think it's 100, which would put the federal funds rate at, what are we looking, 5.12 and a half, somewhere in there, halfway between 5 and 5.25. But if it just follows 25 off of the 5.33, it'll put the new effective federal funds rate at 5.08. We can already see if we're looking at the 5.33, the 2 month is below that, the 3 month below that, the 4 month below that. Look at the 6 month, 4.89. And then not much movement in the belly of the curve, with the longer end of the curve rising a little bit. I think the longer end of the curve is saying, I don't know about 50, but the short end of the curve is saying, well, at least 25. I think that's what we're getting in there. August 30th, 0. Remember that date. Remember where you were that day when the curve went flat. The money market, the capital market curve is still inverted, and it will stay inverted until rates come down quite significantly. Balance sheet runoff continues, another $14 billion down to $6.5 billion in the securities portfolio, $7.123 billion on the balance sheet. That's a net increase outside of the securities runoff, a net increase of $1.6 billion. Let's look at curvature. Now that we have a flat curve, we can see if you draw a line from the 2 to the 10, you have a flat curve. You do have negative curvature And as the curve steepens, we expect curvature to become positive. Beginning of the year, negative 1.23. August 23rd was negative 0.38. August 30th, negative 0.29. This should, if we get a curve that begins to steepen, if we start to see positive numbers here, we should see curvature work its way towards zero. Money market funds. This is it surprising you? It's surprising me. Increased again to 21 billion. Somebody asked me why. Why do you talk about money market funds? It's because it's the safe place to be. It's sort of a measure of the security, I think, that investors feel. If you have money leaving money market funds, it's because it's not that attractive there and there are better opportunities, but money just keeps flowing in. A record amount, 6.26 trillion. Retail up 3 billion, institution up 18 billion. September 18th, FOMC, we are now 17 days away from our first rate cut, 67% probability on 25. You could basically say it's 100% probability that we're going to get 25. There is some weighting to the 50, so it's 67% that it would be 25, 33 that it would be 50, but 100% probability of a rate cut. We can say it that way. I think it's 25, nothing more than 25. Going out to December, not much has changed here. More than 3 rate cuts was 76%, now down to 69.7. A slight pullback there, but not much. In 2 days from Mexico, we get unemployment rate. And in 2 days, US, we get ISM manufacturing. Wednesday, you get the Bank of Canada rate decision. I'm looking for minimum negative 25 here. 50. I don't know. What would the Fed do if it had 2 quarters in a row of 0% on GDP? I think it would. I think that's permission to go 50. Now, it's only been 2 months, not 2 quarters, but you are at risk of running 3 quarters of 0 and printing a whole quarter. No, not 3 quarters, 3 months at 0 and printing a whole quarter. I don't know. For certain, 25. I don't know about the 50. ISM services in 4 days, and it is a jobs week on both sides of the border. 3 days you get JOLTS, 4 days you get ADP, along with initial claims. And in 5 days you get jobs report, both in Canada and the US. This comes after the Bank of Canada rate decision, so it cannot affect that decision, but this will affect the rate decision for the Fed. You get a strong number, and you're going to get a shifting of probabilities to 25 very quickly. You get a weak number, you get something like 60, 70,000, you will have a big shifting over to the 50. I think the rates we see, the rates and yields we see are really dependent now on these 2 data points we're going to get before the rate cut, but I think we're getting 25 no matter what. From the Fed, we're getting 25 no matter what from Bank of Canada. If I had to put a bet on who's going to go 50, I would have to give it to the Bank of Canada going 50 over the Fed. As I said before, effective federal funds rate still sitting at 5.33. That will change before the end of September. Reverse repo, this is normal to see, up 120 billion. It is the end of the month. So it does increase into the end of the month, and it's a long weekend as well. That next week when I show this, this will come right out again. Treasury sitting right near their target. They are targeting 750 billion, sitting at 757 billion, up 22 billion from the week before. Reserves 3.244, down 114. Being that the reverse repo was up, we would expect reserves to be down. The combination of the two minus ample 1.17 trillion at 40 billion a month, still sitting just shy of 30 months before we get to what we think would be ample. Real rates moving pretty much in lockstep with nominal rates, just a slightly less than what nominal rates increased by, so you have a small movement on the break-even rate. Fed funds futures, not a lot of movement here week over week. Q3 still sitting at 33 basis points, which is somewhere between 1 and 2 cuts, which is what we've seen on the probabilities. Q4 69 for 102 basis points by the end of the year. 4 rate cuts by the end of the year. Q1, another 2 rate cuts, 53.5. Q2, 1.5 in there, 34.5 for another 88. So 190 basis points over the next 4 quarters. 7 to 8 rate cuts over the next 4 quarters. TLT did not have a good week, down 1.93%. It kind of makes sense to me. I opened and closed the 102 calls again because it tried to make a run up again. I thought, no, this is not a 50 basis point Fed. Little too aggressive, and it came back down. I don't really like to trade that quickly, but there it was. SPX 0.24, kind of flat week over week. I opened October 95 puts on Friday, though. I did close the 102 calls, and I opened 95 puts at 122 for October. So I did sell the $95 puts for October because I do think we're going in September. I don't think it's 50. I think it's 25. But I think to get the TLT ball rolling up the hill, you got to get the Fed rates rolling down the hill. Once you start that ball rolling, I think it continues on. Implied volatility kind of disappearing, though. It would have been better to sell earlier in the week, but the delta wouldn't have given me 122. So I am short the October 95 puts on TLT, and I am firmly in the 25 basis point camp for September. Nice drop down in mortgage rates, 6.35, a drop of 11 basis points over the same time period. The Treasury, the 10-year, increased by 1 basis point, 30-year decreased by 11, so the spread decreases by 12, sitting at 248. Mortgage REITs doing well, ABR doing well. ABR looked like it was going to have a really good week, then it gave back a little at the end of the week, but still moving in the right direction. Still defying all of those short reports. IYR, the REIT index, up 0.39. XLU still continuing to perform, up 1.15. Housing taking a much needed break because it did run. So I think that it got slightly overextended. I think the reality is these mortgage rates are going to have to come to below 5% before you really start to get a lot of interest, more interest from buyers and bring buyers off the sidelines. They know rates are coming down. They know more inventory is going to come onto the market. So you have buyers, and I think at least in Canada here, it's really a buyer's market now. I think you have buyers saying, look, we're in control, we can wait. So I think housing got a little ahead of itself. I think it's taking a much needed break. I expect to see this for the next, probably into the end of the year, is this sideways movement in housing, maybe even a drift down to make it a little bit more attractive for the spring season. Not much to see in OAS. I've been saying that every single week. Not much to see here at all. Not much to see. As if it's in its own little world. La-di-da-di-da. Doesn't really care. Housing price index for June down 1%. Sorry, I don't think that's 1%. I think that should have been 0.1%. Sometimes I'm dyslexic in writing things down or write things backwards. 0.1. Case-Shiller. Up 0.6%. Mortgage apps up 0.5%. Look at this. Pending home sales down for July, down 8.5%. As far as the level of the index goes for pending home sales, it is now the lowest in index history. And this pending home index began in 2001. It is at the lowest level since 2001. And that is why I think this is taking a well-needed break. New positions, I have those on the site. Remember, last week was the last week that I was going to show new positions in the market outlook. That is now on the site. I highlighted 5 stocks that I'm beginning an allocation factory on and overlaying an income factory on. I did not update my positions. I just introduced those new 5, and some people pointed out that, hey, what about the other ones? I will be adding another video today. Now, I'm going to do it today, but it is a long weekend. It is a Labor Day weekend. Whether anybody in the IT staff will take a moment and load it onto the site. I can't speak for that. I don't expect them to. I wouldn't hold their feet to the fire and say, hey, you didn't do this. If they're hanging around in their condo, you know who I'm talking to out there. If you're hanging around in your condo and it just happens to cross your email and you just happen to put it up, that would be great. But you'll still be my friend if you don't. But I will do that video this afternoon. When I did the new positions, I was thinking, well, I'm just doing the incrementally new positions. But somebody did say, hey, you said you'd tell us all your positions. So my fault. I left that out. I will add another video today. So if you have the applied level, if you had the applied level subscription by July 31st, you will find this in the portfolio construction module in a folder called positions. And it has, the first one is up, and it has the positions, and I will be writing the date beside each one, so you'll be able to follow all of them. So if you do have that, you can head over there and see the new positions that I'm looking at, and later today, or worst case scenario, early Tuesday, another video will be up. Okay, gotta talk about Nvdia. That was sort of the big event for the week. I know there's a lot of writing on the screen. Let's just dig into a few things and see if they cause you any concern. They did cause the market some concern. Nvdia did sort of take a little dump after hours. But then by the end of the week, it was like, yeah, okay. And then some investors, institutional investors are coming out saying, oh, you got to own it. You got to own it. This is what started it all way back here. 141% increase over the previous quarter in data center revenue, followed by a 40% increase, followed by a 26.8% increase, followed by a 22.6% increase, followed by a 16% increase. Do you see that going on? The growth rate quarter over quarter is leveling off. If you look at their 10K, the MD&A, page 29, 4 customers make up 46% of this 30 billion. 4 customers. And they list them as just customer A, B, C, D. Customer A is 14%, B and C are 11% each. Customer D is 10%. 4 customers making up 46% of the 30. It's more likely they're making up 46% of just the data center revenue. I put the usual suspects up here: Microsoft, Meta, Google, Amazon. I'm probably right on at least 2 of them, making up customer A, B, C, or D. I'll bet you Microsoft or Google is your customer A. I don't know, maybe you have some other thoughts. What happens when they're done building? What happens when they get to the scale that they want and they're done? Each of these, 14% of revenue, 11% of revenue, 10% of revenue, when your quarter over quarter is leveling off at 16%, you lose 1 customer. Or if all customers say, okay, we're almost there, let's cut our orders in half. There's 23% of your orders gone. When you're growing 16, you could face the very real prospect of having a negative quarter. Negative in the growth rate, still quite profitable, but negative in the growth rate. Look at their other categories. Gaming, 2.8 billion way back here, 2.8, still at 2.8 flat. Professional visualization, 416, 463, 454, basically flat. OEM and others, 73, 90, 78, 88, basically flat. And auto, some growth here, 261, 281, 329, 346, some growth, but this is a data center play, and the growth rate is inflecting to a flatter level, and they do have customer concentration risk. Their gross margin, 75.1%. Last quarter was 78.4%, quarter over quarter, shrinking gross margins. Guidance, they've given guidance of 32.5 billion for the next quarter on revenue. Gross margin 74.4%, also more contraction from the 75.1, a drop in gross margins, 70 basis points. OPEX 4.3 billion, tax rate of 17. So if we take their revenue multiply by their gross margin, take out their OPEX. This will give us our gross profit, take off OPEX to get operating profit times the after-tax amount. 16.5 billion net income, which it would be down 0.6% quarter over quarter. So they are guiding, basically call it a flat quarter in their guidance quarter over quarter. So being that it's flat, we can look at forward quarter EPS with zero growth on the EPS, even though you might have top line revenue growth. Your OPEX seems to be growing faster and your gross margins are shrinking. So your EPS growth, I put it flat at 268, gives them a PE of 44.76 with an earnings growth of 0%. That makes them quite expensive. If we look at EPS, 68 cents, this is non-GAAP, 68 cents, up 11% quarter over quarter. So even though data center revenue is up 16.4%, after you filter down to earnings, you're only up 11% quarter. I say only, but we're talking about Nvdia here, so we can use the word only after seeing the big numbers we've seen. 11% quarter over quarter is pretty good for most companies, for almost all companies, but being that we've seen big numbers. So I think this was the big problem over here, is once you do a quick calculation with the guidance, you're getting on a net income basis to having a flat to slightly negative quarter over quarter. So is the big story done and now it's got to be priced out as a mature company? Is it still an extremely rapid growth company? This is concerning, right? 78.4 to 75.1, guiding to 74.4. So if you have increasing revenues but decreasing gross margin and increasing operating expense, you're saying my revenue is going to increase 8.2%, but my gross margins are going to shrink and my operating expenses are going to increase 17%, right? Operating expense growing faster than revenue with a shrinking gross margin, you get to flat net income quarter over quarter. Everybody take a deep breath in and clutch your pearls on this one. Let's have a look at the dollar index. It did recover, bounced off the 100.5 level twice, and then up we went, crossed the 100 level. That was a critical level as well, sitting at 101.625, still below the 200-day moving average at 103.95. Predicting the direction of currencies, brutally difficult to do. In the short term, very short term, we can look at the expectation for interest rate differentials. Longer term, we have to look at something a little bit more fundamental. In the mid to long term, it's usually purchasing power parity that will do it, but I don't know that we really want to get into that, and I don't really know if we want to forecast something out for the next 5 years. Let's just see if we can't figure out something over the next couple of quarters. So over the next 30 to 60 days, I think interest rate differentials are everything. If there is a belief that there's going to be a faster pace of U.S. cuts, it will lead to a lower U.S. And I think what we're seeing here, this rebound in the dollar index, is a realization that the Fed's not going to lead with 50. The Fed is probably going to lead with 25 and cut at a more measured pace than what the market is already pricing in, this 190 basis points in the next 12 months. The dollar index doesn't seem to be agreeing with that. I think that's probably the right move. If you get any data that suggests a faster pace of rate cuts, it will weaken the US dollar. So I think in the short term, 30 to 60 days, we're really looking at the sentiment on the pace of rate cuts. If the data comes out that suggests that inflation is coming down like we've seen, but it's certainly not dropping off a cliff, and the economy is strong, and unemployment is a little elevated, but it's certainly not rising in some unexpected way, then yeah, I think you have measured rate cuts. I think the US dollar pretty much keeps these levels. Elections, that's going to matter. And I think if we're forecasting out the currency, 60 days from now to 6 months from now, I think you have to factor in the election. we can state something, I think, with almost certainty. Both Trump or Harris, regardless of who wins, both will increase the debt. Period. Both will increase the debt. With Harris, I would bet on a weaker U.S. dollar because while she would increase the debt, I think she would avoid tariffs, and her policies, or at least the more left-leaning policies, may be more punishing to capital and capital owners, but less inflationary, which would allow the Fed to achieve a lower level on the Fed funds rate, which brings us back to expectations for interest rate differentials. I think Harris, if you have a Harris government, I think in the 60-day to 6-month time period, you could forecast a weaker U.S. dollar. Trump, on the other hand, wants lower rates. He's said so. He wants a lower U.S. dollar. He said so. He wants tariffs. Can't have both. Can't have lower rates. Lower rates will give you the lower U.S. dollar. That's how you get that done. But you put tariffs in there, the Fed is going to be much more cautious because the belief is tariffs will be inflationary. So you get a Trump election in November, you may get a Fed that decides to hold off on rate cuts a little bit longer to see what Trump wants to do. That could lead to a stronger U.S. dollar, higher rates. But if he does implement tariffs, that could result in a U.S. dollar that keeps its levels because the Fed would keep its interest rates. If we go past 6 months, we start looking at just the sheer debt levels. Higher debt levels under both appear inevitable at this point. So going past whatever Trump would do with tariffs, if he wins, or whatever Harris would do with the punishment of capital owners, you're going to get higher debt levels and deficits, probably deficits as far as the eye can see. So the Fed would probably have to move to zero just to save the economy from the weight of the debt servicing costs that would pile up, because you'd have growing debt at higher rates. You would have to bring those rates down for the other part of the mandate, just because you would crush the economy with higher and higher taxes. And that would put longer-term downward pressure on the U.S. I think this is inevitable. I think in the longer run, 6 months plus, I would look for a weaker U.S. dollar. In the short term, I'd be paying attention to interest rate differentials, and I think the market itself has got it wrong with 200 cuts over the next year. I think the U.S. dollar index probably has it right in this recovery up here, that it's not going to be as great and as fast as what the market is pricing in. Elections bring in a level of risk. If Harris wins, I think the U.S. dollar could begin its downward trend. I'd want to be in U.S. duration at that point. Because while I need U.S. dollars, because you'd have lower, the Fed would have permission to go lower. If Trump wins, I wouldn't bet on a weaker U.S. dollar, but it would make the duration trade less interesting, I think. But 6 months plus, longer term, because of that level of debt, I think you're going to have the Fed move to zero. Let's jump out to 2028. And let's look at a more important measure, not just the level of debt, but the level of debt to GDP, because it will be different under Harris and Trump. I think under both, debt increases. However, I think under Trump, GDP increases more than under Harris. Once you start punishing capital, you start affecting growth rates. And she seems willing to punish capital. The debt to GDP ratio under Harris, I think, will be higher than the debt to GDP ratio under Trump. But in 2028, I think you can expect to see debt 25 to 30% higher than it is in 2024. So take the level of debt in 2024, add 30% on, regardless of who wins, add 30% on, but that the debt to GDP ratio under Harris would be worse, because under Trump, I think you would get, favorable tax regime and no punishment of capital, which would lead to higher GDP growth. Harris is more willing to punish capital, getting you to a lower GDP growth, and I think they both get to the same level of debt, making Harris probably the more damaging one for the value of the U.S. dollar. If we're looking at the credit desirability or credit rating of the U.S. on its debt to GDP ratio, it would be worse under Harris. Let's move over to SPY, and let's bring our discussion of the dollar index over to here. Why spend so much time trying to figure out which way the U.S. dollar is going to go? I think it will have some effect on the S&P 500. It will have some effect on the U.S. market. If we look at the propensity, that's a good word, the propensity of other investors to invest in the U.S. market versus U.S. investors investing in other markets, I think it's much higher that the U.S. market has a lot more foreign investors in it than foreign markets have U.S. investors in it, because the U.S. market is the biggest in the world. Some countries don't have a very robust market, which means most of the money is in U.S. markets. So there is a lot of currency risk attached to the U.S. dollar. And you can make the argument that, well, if the U.S. dollar decreases, it is kind of like an unwinding of a carry trade because of the currency risk. The investors in other countries would sell their U.S. dollar assets and repatriate their funds. You could also make the cases as the U.S. dollar decreases, the U.S. market becomes cheaper when denominated in other currencies. And since the markets in these countries aren't big enough, they got to be in the U.S. market anyways. It's uncertain which way it's going to go. One thing I think that we can say is it will add volatility. So if we have a weakening U.S. dollar, the one thing I can expect is increased volatility in U.S. equity markets. Direction kind of uncertain. So let's just keep that in mind. Let's see where we are here. 563.58, just 0.145% below an all-time high. If you were watching the price action going into 4 o'clock on Friday, 359, 359.30, like 30 seconds to go. It did look like it wanted to print above 564.40. I saw 564.10, 564.15, 564.20, and I thought, we're going to do it. Even if it's just a penny, we're going to do it. And then it pulled back right at the last 30 seconds. All-time high, 564.40. You could basically say we're there. Look at that. Another one of these, 2008, 2009, 2010 type recoveries, complete V-shaped recovery. We're right back to those. Forward 4-quarter operating earnings, LSEG updated, SPGlobal didn't, so I'm just going to use last week's with a closing index of 56.48, puts it as almost 22 times forward operating earnings. That's not as reported, by the way. That is operating earnings versus 21.8 the week before. Surprise factor sitting at 4.7. Implied volatility drifting away, but kind of still in there. Let's look at rate cut expectations. September 18th, rate cut 25 basis points is the base case. That appears to already be priced in to the market. If we look at the probability of a rate cut, it's 100%. The weight is on the 25. No one thinks it's zero. It's since we're at that point, it's pretty much priced in and maybe a little bit more than 25. Look at the 1 year sitting at 4.38. That's pricing in 200 basis points of cuts. And not only that, it's almost where it is right now at 4.38. That is 2 cuts since January 1st. January 1st was sitting almost 50 basis points higher, and now it's pricing in 200 basis points of cuts over the next 2 years. You're probably thinking, how is that 200 basis points? Let's assume that you have a 1 year investment and you're starting with investing at 1%, and halfway through rates are cut to 75 basis points or 0.75%. You have a weighting of 50% on 1%, and 50% of the time, and a weighting of 50% on 0.75 gives you 0.875. So the 25 basis point cut is 12.5 basis points below where we are. And since this is, linearly over time with each meeting, we can take the 200 divided by 2, get 100. We're at 5.33 on the federal funds rate. This is 4.38. And over the next year, if you say it over the next year, looks like 200 basis points are in there. That's aggressive. I think that is a little aggressive for this Fed because they have not been getting the data that gives them permission for that, which means I think that this is aggressive on the S&P that is hoping for rate cuts. I do believe the S&P is at a fundamental top. I don't know fundamentally that you can justify much higher levels on this index. Although it may be at a fundamental top, it may not be at a psychological top. But the fundamentals show up. No matter where psychology goes, the fundamentals eventually show up, and I'm betting that the fundamentals show up. So I will be increasing my negative beta in the coming weeks by directly shorting SPY and directly shorting IWM. I'm not going to use options or derivatives. I'm going to actually short the underlying themselves. And continuing on with the US dollar, I don't believe that US dollar weakness is a sure thing just yet. So it is going to affect valuations of US denominated assets and money flows, I think, for the next 30 to 60 days. As you get closer to the election, there might be some shifting based on what polls say, but the election itself, I think, will create some result in the US dollar, but not until we get past inauguration and get into February and March and see what the policies are. Will the US dollar finally decide what direction it wants to go? But if you're betting on US dollar weakness in the near term, the next 30 days, I don't really think that's going to be a thing. I don't think the jobs report is going to give the Fed permission for 50. I think 25 is basically in the books. I think that's already in the price. I think we are at a fundamental top. I just don't see what gets us higher at this point. We have to start looking past the idea that we're at a top in rates. We are going to be on the rate cutting cycle. We have to start looking at the election. We have to start looking at the policies and the debt. I think we have to start looking at all of that. Coming up this week, 6 companies reporting, LSG and Sector Spider, both in agreement. Are they listening and getting their act together, or is it just because it's 6 and it's hard to mess up with 6? Wednesday, Dollar Tree, Hormel, and Hewlett-Packard Enterprises. Thursday, big one here, Broadcom. And Friday, we have Kroger before the bell. Friday is Jobs Day. Friday is going to be everything for Canada. Wednesday is Bank of Canada. That is going to be quite a bit. If you have the applied level, as I said, I'll put a second video up for new positions. In there, I'll also talk about my position on the Canadian dollar and what I'm doing with the peso. Okay, I know it's Labor Day. It's September 1st. The market isn't open on Tuesday. I normally do a live session every Sunday night at 7:15. It is a long weekend. So, I was thinking, maybe I'll move it to Monday night, but I think consistency is more important. Even if I don't have the same number of people checking in, they can always watch it and replay. So I will be doing a live tonight, 7:15, as I do New York time or Eastern time, however you want to look at it, Toronto time. I will be doing a live at 7:15 p.m. on Labor Day. I'll see you there.